Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Hello, welcome to UTI's Outlook for Fixed Income Markets. I'm Amandeep Chopra, Head of Fixed Income. RBI's fourth bi-monthly monetary policy was fairly positive for the bond markets. Unlike the earlier expectations where the markets were looking at some degree of rate hike or hawkishness from RBI, the net outcome was actually quite positive. So this was driven not just by a pause, unlike 25 to 50 basis point rate hike expectations, it was also driven by the post-policy commentary. If you looked at the inflation outlook and the guidance that RBI provided, they had actually reduced their estimates for both the second half of the current financial year as well as the first quarter of next financial year. So this was perceived quite positively by the markets and they did rally significantly. The other big positive for the markets was clearly the post-policy commentary by RBI, where they hinted at some degree of dovishness when they mentioned that the change of stance towards calibrated tightening did not indicate any sign of deferred rate hikes, but was actually more of a binary outcome related statement, which meant that the future course here could either be a pause, which means no rate hike, or a potential rate hike. I think in this backdrop, the markets chose to believe that going forward, you may actually see no rate hikes in the near term. And this is largely in the backdrop of the fact that the inflation trajectory over the next 2 months before the next policy event of December is going to be fairly benign, and in that environment the rally that we saw post policy may actually sustain a little bit longer. Coupled with a positive RBI policy, we also saw some actions taken by the central government and RBI to sort of reduce the volatility in the bond markets. Primarily the reduction in the government's borrowing calendar for the second half and announcement by RBI on open market operations were perceived very positively by the markets, because both of them actually do tend to reduce the net supply in the second half, and this was a big strong positive for the bond markets. So the result of all this, I think in our view, will largely be that the 10-year yield over the next few months will remain relatively in a lower, narrower band, and I think that is something which will be a good outcome for the bond markets. So one of the reasons why the market participants were expecting a rate hike from RBI was largely to address the rupee volatility. In the recent past, we've seen a fairly strong rupee depreciation against the dollar, and this in some ways was perceived to be negative on inflation, because along with rupee depreciation, we've also seen oil prices move up. So the twin impact of this clearly would have been on retail level fuel prices, and hence could have possibly fueled inflation. So the expectation around RBI's monetary policy announcement on a potential rate hike was also built around their attempt to try and curb the volatility in the rupee. However, the Monetary Policy Committee clearly did not see this as one of its key objectives and focused much more on their inflation outlook and the guidance that they provided. So in this backdrop, I think from our perspective, we do see rupee to be somewhat weak. This is more in the backdrop of what's happening globally. There clearly is balance sheet tightening by the central banks in the developed markets, coupled with a widening current account deficit for India, largely driven by firm to rising oil prices and a relatively wider trade deficit. So I think in this backdrop, clearly the macros do not support any strength as far as the currency is concerned. We would continue to see rupee depreciate over here, and I think if oil were to continue with its current price trajectory, then you could actually see oil trend up, the rupee trend up much higher. So in this backdrop, clearly we will have some degree of concern as far as local markets are concerned. While post policy, there was a rally in the bond yields, and like I mentioned earlier, the markets did perceive the policy to be fairly positive for bond markets. I think from our perspective, we see this as somewhat temporary, because the concerns which essentially kept bond yields relatively elevated are still out there. So just to bring the perspective into this, over last 1 month, we've actually seen most of the developed market bond yields move up. So the US Treasury yields over last month have almost moved up by 30 basis point. UK Treasury yields are up by almost 23 basis point. across European region, most of the countries have seen their 10-year bond yields move up between 11 to 18 basis point. Even Japan, which does not see too much of yield movements for their 10-year benchmark, has actually seen yields move up by 5 basis point. Over the same period, post the policy, the Indian 10-year yields are actually lower by 3 basis point. So clearly there is some degree of risk which is being priced in by the key benchmark rates overseas, which is not yet reflected in the domestic rates. This, coupled with some of the earlier concerns that we talked about, essentially revolving around oil, the Federal Reserve's stance on future rate hikes. Clearly there is some degree of disenchantment with emerging markets and the flows have been very weak. We've also seen oncoming elections which do present some concern around some degree of populism, which again could be negative for the bond markets. And I guess finally we have seen some degree of outflows coming in from most of the FPIs. I think these are the negatives for the bond markets which could sort of prevent any sharp rally in the 10-year yields. On the positive side, we have seen some attempts by the center and RBI to address the rupee volatility through a combination of administrative measures to lower the trade deficit. We have seen RBI, like I said, come out with open market operations to address domestic liquidity. And of course, we've also seen the central government lower its borrowing calendar for the second half. These are largely, in our view, some of the measures taken to try and address any sharp rise in yields. However, the broader global macro still presents a fairly high degree of risk from our perspective. And while this will mitigate, at least in the near term, any sharp rise in the 10-year yields, however, from a medium to longer term perspective, like I said, the risks from from our viewpoint have not declined meaningfully enough to really look at a significant decline or a sustained decline as far as the 10-year yields are concerned. So I guess in this backdrop, clearly we are still in a risk environment over the next 2 quarters. And from a fund perspective, clearly duration is not something that we would advocate right now because like I said earlier, not just this change in RBI's policy stance, but even our expectations around potential rate hikes from here on does not present a credible investment idea or opportunity in the duration funds. So the focus, I think, would largely still remain around accrual and capital preservation. So the short end products in the ultra short term, low duration and short term category from our perspective are the right products in the current environment. We also think products where there is actually very little interest rate volatility, essentially around the fixed maturity plans, present a very good investment option for investors in this environment. So to sum it all, clearly our conviction levels as far as the recent rally and a sustained decline in the bond yields is very low, and we've already highlighted the reasons why we think the rates could actually head up higher from here. Even in terms of the broader macro and currency, we are somewhat more cautious. And in this backdrop, we have recommended products which we think would be more suitable for investors who do not wish to add on risk or volatility in the portfolio. So I thank you for listening to me, and I hope this market outlook and investment advice is useful for you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.